Todd and I are about to be in.
All right, everybody, welcome to the Friday Mastermind. We're here every Friday, 9 o'clock, to bring value to the mortgage industry, make you guys smarter. One of the keys to what we call the data-driven mortgage advisor, the compass, is know the data and educate with data. That is due west. Due north, be a mortgage coach. And so Dan, get it. Well, first of all, let's give everybody a chance to talk. We brought Todd Bellinger. He's not the special guest today. He has been the special guest before, but he's going to help host this. And then he's got some numbers that he wants to share, some data he wants to share. What's up, Mr. Bellinger?
Howdy. Thanks for having me.
Deborah Bird, how cold is it in Dallas, Texas right now?
We have just got above 32 degrees, so hopefully we start thawing out.
Todd, what's it like in Phoenix, Arizona?
Well, I don't know if you can see the sun on me, but it's about like 60 degrees and beautiful. And
oh my gosh.
Just, can't really complain. It was too nice not to actually broadcast from the backyard today. So hope everyone is having a blast. I know, kind of excited, Dave, less like 5 weeks away from Modern Mortgage Summit, Modern Real Estate Summit. So that's going to be just a blast. So
yeah, just a reminder, folks, guys, the Modern Mortgage and Modern Real Estate Summit is coming soon. The difference this year from previous years is there is a live element of it. So the 12 mortgage professionals that are going to be speaking are actually going to be at the event, delivering a 15-minute keynote, TED Talk style. And then we're going to have, is it 4 or 5 real estate badasses that we're going to have? Is it 4 or 5?
Five real estate badasses, including like Tristan Nahumada, who started Lab Coat Agents. We've got Spring Benson, #1 agent at Real Broker, Jason Mitchell, #1 agent in the world.
So they'll be there, guys. They'll be at the entire event. It is a place to be. We still have some tickets available. We do think it's going to sell out because it's limited to 60. The venue we have is, it's got 60 lounge chairs in it. And when those lounge chairs are gone, we're not going to go standing room only. So today, our special guest is Dan Rawitch. Obviously, we've had a couple good days, maybe a good week. We're going to find out, what we have to look forward to and how fast we're going to get out of the winter. So Dan Rawitch, Chief Economist for MortgageCoach Sales Boomerang. Tell us what's up, brother.
All right. Thanks for having me, Dave. I feel like it's been a while, but I don't think it's really been that long. I live in a time warp. I really don't know. So can I just go in and kind of start sharing some slides?
Yeah, let's go.
Or did you want to keep doing a round robin thing?
Whatever you want to do, man. You want to say hi to people, you want to say something outside the slides, or you just want to get into the data?
You know me, let's just get into the data.
I know you. That's what I thought.
All right, let me see if I can make this in presentation mode. I thought that was cool. I just stumbled onto that. Microsoft's getting so smart. They saw the title and then turned it into this cool thing. So that's my favorite thing of the day right there. Okay.
Dan's getting techie. I like it.
Isn't that cool? No, I just clicked on the little designer.
And I love that name. We should have named this call. The shift has begun. Let's go.
It's not too late, Dave. Okay.
That's what we're going to call it.
All right. So I'm going to do something in reverse because I have a tendency, why won't that switch? Just to forget. And I know this is probably rude. I haven't given you anything yet and I'm asking for something. But this is free. You don't even have to take out your wallet. But universityofoptions.com/attend a free live trading session. We started doing something we'd never done before because I make that blurb on MortgageCoach almost every day and through other websites, and it almost sounds like scammy, I think. And I hear a lot of people coming to me and say, if I didn't know you, I would never believe this. But we haven't had a losing day trading, and I honestly don't know when. And of course, I can, show you those stats. But the best thing that we found to do is just invite people to come into the live trading room with us and just watch us, literally trade alongside of us. You might not know quite what's going on in the beginning, but I'm not saying here's a link just for the day and maybe hopefully we'll make money the day you're there. I'm saying use this link as long as you want. Just don't pick me up and start trading. We did find a couple people. say, hey, I made enough money to pay for your course, so thank you. But just, yeah, that's that. And then the other thing, and then I don't have to say another word about it, is our new Facebook group, Trade Like a Wall Street Pro. All right, let's go. So the title is The Market, the Shift Has Begun. And when Dave asked me if I could speak today, I said, I don't think the timing could really be much better, because a lot of the things that we've talked about over the last several months are coming to fruition. Some of them still may seem like wild, fallacious statements, but they're not. And the one thing that I said is, and this was probably in July of last year, that next year, this time, we're probably going to be talking about deflation. We're not going to be talking about inflation. And that's going to happen. The other thing that I said was, I believed in the fourth quarter of the last time I was with you that was bottom in terms of the worst it's probably going to get, in terms of rates, and probably home buying activity, and probably the quality of deals, because I'm hearing from so many loan officer friends that the deals are just tough right now. And that's usually what happens when the business dries up. We kind of start accidentally bottom fishing. So I think all that is playing out. And then on Mortgage Coach about a week ago, I wrote something, and I didn't even think about the severity of what I was writing, but I meant it, and I stand behind it. It doesn't mean I'm right, but usually, as you guys know, when I make a forecast, I try to put as much beef behind it as I can, because I don't like people just say, hey, this is going to happen. And I always say, not trying to be contentious, but why? Why do you think that? I don't want to argue with you whether or not it's going to happen. I want to argue with you about why you think it's going to happen. And if you have good points, I will yield. So I wrote that I believe in the third or fourth quarter, we could see a 10-year go sub 1% again. And I'm going to show you some reasons why now. And of course, I have to cover my, you know what, because that's what I do. I am talking about the current trajectory that everything is on. Now, things can change, in the next couple of months, but based on the facts that we have right now in front of us, I stand behind that prediction. And so let's go through some things. This is jobless claims. Everything I'm trying to do is going back like 4 months. And it's annoying to me when everybody wants to talk about inflation year over year. You cannot compare right now this year with last year. And you certainly couldn't compare last year with the year before. These have been extreme times. So at no point does the year over year comparison even work. Unfortunately, kind of on real estate prices too, but you can't look at year over year, you have to look at month over month. And so everything I'm looking at, everything I'm basing all these forecasts on are month over month projections. And while Powell and some other economists may say, well, that's too soon, it's not a trend. Well, guess what? A trend starts with 3 or more months. This is a trend. So jobless claims are on the rise. They're still historically very low, but I don't care. This is what I care about. I look at charts for a living. In fact, my thought for the day yesterday on Rawitch was everything in your life is trending. Your weight, your physical appearance, mine's trending badly. Your financial picture, your career, your relationships, everything is trending. And your job as manager of your life is to make sure that the trend looks like this and be realistic. But there's really no neutral. Nothing ever stays flat for very long. So trends are kind of important to me. Oh, good Lord. Oh, this is the ADP. So automatic data processing job numbers. This is going back till March-ish. You look where it's going. And let me tell you something. I trust these numbers so much more than I trust the government numbers. And this week was an insane week because ADP said we only created 100,000 jobs. We need 175,000 just to keep up with everyone that's dying. So we're falling in the wrong direction with this number. And yet then the Fed number comes out this morning at 500,000. It was stunning. But if you look at the reaction of the stock market right now, I think you start realizing that even the markets looking through that number and saying something's wrong. So I'm looking at this trend, and you can see where that's going. The Fed, I would say now at this moment, his biggest concern, or their biggest concern, are the job numbers, even more so than the inflation numbers. They're worried about wage pressure. And this week we also saw wage pressure deflate quite a bit. We saw a lot of air come out of that balloon. So this is worth paying attention to. And this is the slide that you can't ignore. It's probably the most important slide you could ever look at if you're talking about interest rates in the future. This, I didn't make this. This came from the government. You can see that inflation peaked about when I said it did. And it didn't take a rocket scientist because I chart everything, and charts are charts. They don't lie. This is trending down, and it has been. And if you look at these month over month numbers, the decreases, it's really sharp. And I'm going to show you when we look at an interest rate chart in a minute. Graphs have a tendency to repeat their angles. So in other words, when you get a sharp angle up, you're going to get a sharp angle down. So this kind of V recovery in inflation doesn't surprise me at all. And you can kind of see where it probably will settle down, and that'll be just fine. And that, I don't think it's going to stop there, but it might rest here. But the Fed needs to stop focusing so much on this. Most people understand that the Fed is always late to the party. They always overcorrect, and they're constantly in this phase of adjustment. The analogy I use, if I'm flying my plane and I'm looking down the runway and I've got this crosswind, blowing me off, of course I have to, turn into the wind. They call it crabbing. And what new pilots have a tendency to do is when they're getting blown off, they overreact, and they get the nose of the plane too extreme to the starboard side. And all of a sudden now they're on the wrong side of the runway. They go to correct back. The wind is blowing very hard this way. They're not thinking the same correction that took them that way. It would take a fraction of that to go back the other way because the wind would have done it for them. So you're constantly, it's terrible. And this is what the Fed's done since I was in college, and they're doing it now. This needs to stop. And I think the fact that he raised 0.25% said maybe he's beginning to agree. We'll see. Now this is corporate earnings, and they're not going in the right direction. And I get a lot of people asking me pretty much every time we have 3 or 4 plus days in the stock market. I'll get a lot of texts and emails from people saying, should I get back in? Well, I'm not. My long-term money, as most of you know, went out the very end of December, half. The rest went to the sidelines early January. Normally, from a technical standpoint, meaning the charts, I would be going back in because some milestones happen that would normally take me back in. But I believe that it's a sucker punch, because when you look at the corporate earnings, there is no way on earth that the stock market can go up when earnings are declining. There's just no way. Right now, the stock market's fighting this, and it's fighting the Fed. Fed wants the market to go down. You can't fight the Fed. Ultimately, it's going to give way. We don't trade based on these biases. We trade what the market gives us, but that's trading, which is different than long-term investing. So just to answer that question, I'm still on the sidelines, and I will remain on the sidelines until this stops. And 2 things I've always said. One is earnings are always the last to go, right before jobs. And you can see what's happening with earnings. And I believe jobs will follow. And now the Fed's got a whole nother problem, because now he's got rapidly decelerating inflation, moving into disinflation, and he's going to have a shrinking job market. This is the earnings sentiment. So this is coming from Goldman Sachs research, CEOs, etc. The earnings sentiment is lower than it's been since 2020, right? I'm talking the mouth of the pandemic, and quickly approaching the Great Recession. Can somebody explain to me how the Fed cannot be talking about this stuff? How can he be talking about a concern of inflation or employment? How many companies can keep people on staff when this is happening? And in fact, I'll show you in a second, This is a slide of the earnings revisions. That's this gray line, EPS, earnings per share. E is estimates. And you can see that companies have been revising their earnings down since April of 2022, about where I called the kind of where I thought inflation was going to be peaking. But you can see the S&P just keeps fighting it, and it keeps coming up. So this at some point will fail. And this slide even says third time less charm. You know, that's saying three's a charm, third time's a charm. I don't remember how it goes. This is hard to see, but these are layoffs in 2022. These are some very big companies with some massively big numbers. These are companies that you don't normally associate with layoffs. Master Cloud, 20, some of these are just huge. OpenSea, 20%, Lyft 2, that's not so big, but I'm not going to read it all to you, you get the idea. DocuSign, 9%. That was 2022, not good. 2023, we're already off to a pretty bad start. And in some cases, you're seeing 10 and 20% of people's workforces being laid off. Salesforce, I don't remember when they last laid people off. Now 10% of their people. Goldman Sachs, a Wall Street firm, who knows better? Lots of people, but they're pretty in tune with what's going on, laying 8% of their folks off. PayPal 7%. So we're not going in a good direction economically. And if we cannot tolerate high interest rates, when this is happening. Okay, so let's just look at some technical stuff here. Over the years, I've talked about the Thomson Reuters commodity index. This is a chart that has a basket of basically all of the crucial commodities. And if you can remember back around this time, which was about August-ish of 21, I began getting pretty concerned about interest rates because this commodity index just started shooting up, and it shot up well in advance of interest rates. And that's not uncommon. We often see somewhere between a 12 to 16 week lag between major jumps or declines in commodity prices and as it correlates to interest rates. And this peak was about 16 weeks from the peak of interest rates. And so when I look at rates, I'm not looking at them in a vacuum. I'm thinking commodity prices. These are the things that things are made from. You know, this is an important basket of goods. It has done nothing but free fall since the summer. And this jump in interest rate yields coincides extremely tight with this drop in the commodity index, with that lag that I talked about. And so I do believe this was top. If you want to talk about bond prices, we could say bottom, but you always have to remember bottom's choppy and nothing really just moves in a linear fashion. Things are going to look like, oh my gosh, hallelujah, life is good. You know, I can make the payment on my sports car again. And then you get these bounces, and they're normal. The stock market breathes. Specifically, the market always moves in 5 wave counts. And these are really hard to see, but and I don't have the first or second wave, but this number 3, this was the 3rd wave in a 5 wave count of what's called the LA wave sequence. And then you get this next wave as a 4. And so we knew when this 4th wave was finished that the 5th wave was going to be a doozy, because that's how LA wave works. There's a lot of math behind these numbers. Now, interestingly, every wave has 5 waves within it. So you can see just this number 3, hard to see, but all the way down here is a number 2. So that was the 2nd wave. And then you have 5 waves within this wave that went from 3 to 4. 1, 2, 3, 4, 5. So we finished our Elliott wave 5th count. It's important. And then what happens is you go through this A, B, C corrective sequence. So you're always going to go 1, 2, 3, 4, 5. You can have 5 within 5. You even have 5 within this 5 in this one, believe it or not, but we don't need to go that macro. And now we're concluding this ABC sequence. So the next wave will be a 1. I'm hoping we do get down here somewhere to the C, and the 1 should be somewhere, up in here, but nowhere near the tops here, because this 5-wave sequence doesn't always work this way. But the fact that this 5-wave sequence was straight up and the break was so clear when the trend was broken, the 5-wave sequence is going to be a down wave sequence, I believe. And so, but again, that means you could go up and down, you're still trending up or you're still trending down, but when you're in the middle of a wave, it doesn't feel like it. Okay, so now how could we go from here to where I said, in the next 10 months? How's that possible? Let me show you some things here. You'll like this. So fairly randomly, I have to look over on this slide because it's bigger. So this period here, you know what? Let me actually bring up the real chart. Then I can give you time frames. How am I doing on time, Dave?
You're doing, hey, this is why we're here. So you got as much time as you need, bro.
Because you know me, once I get talking, it's hard to.
It's good. I mean, well, we want to have it, at least 10-ish minutes for Todd.
I'm probably within 5 of wrapping up, and other than any questions. So this is a simple thing here. This is time and distance. So what this is telling you is back in July of 2009. I have examples all the way through the years, over and over. I can go back and find you 20 more. But what this is telling you is from July. Well, basically, it's telling you that over a 225-day period, or 32.
Hey, Dan, I don't think we're seeing your screen, Dan. We're seeing the slide that you were showing that you said you were going to show.
Thank you so much. Sorry. All right, thank you. I've done that for really long periods of time before. So this is telling you that over a 32 bar period or 225 days, this was a 210 basis point drop. So about 7 months-ish, 200 basis points. Take 200 basis points from where, we'll say we were yesterday, you're at 140 basis point on the 10-year. And this was not necessarily like the most extreme drop. And then fast forward a couple of years, or a year actually, over an 84-day period, so not even 3 months, another 210 basis point drop in the yield of the 10-year. And then fast forward over here to 2010, 147-day, 160 basis point. Any one of these is going to take your 10-year down into the ones. Then we have 2011, 200 basis point drop in 160 days. I didn't measure that one, but you get the idea. This one was just 140 days, 130 basis points, 180 basis points, 150 basis points. And then if you get into recent history, this is where it gets important. This was 6 months, 200 basis point decline. So just take recent history and do that again. And again, we're at the 1.5 level and nothing happened. There were no catalysts here. I'm talking about significant catalysts coming our way. I'm talking about inflation, unemployment, et cetera, that is going to make these numbers look small, in my opinion. And then very recently, we had going up another 190 basis points in about 90 days. So here's what I want to tell you about charts. And again, if you're in my group, you know this, we trade this every day, this information, but the path up is very often going to be followed by the path down. So there's trading tools that will measure angle. So this angle and this angle are going to be pretty similar. They may not be the same in distance, but like this, straight up, straight down, straight up, straight down. The point is that if this trend continues, I believe it will continue on a very similar trajectory than it did on the way up. It's just the way it works. This was a little slow, more rounded up, more slow, rounded down. Up, down, same angle. up, down, same angle, up, down, same angle, same. You get the idea, right? So this is why I believe we're going to get a pretty sharp move. Commodities just keep getting cheaper and cheaper. I don't see any way that they're going to stop. And so I do believe we could see a sub 100 by the end of this year. And that assumes the same trajectory. So if you come back a year now, you told me this and that. Well, guess what? Inflation went the other way. Yeah, I was wrong about that. And companies stopped laying off. But all I can do is read the tea leaves that are right in front of me. And that's my read.
So stop sharing the screen unless you have another image. I want to fireside chat around this, get everybody's questions. So before we all start asking questions and sharing takeaways, what do you think rates will be at their lowest in 2023? What will be the lowest 30-year fixed rates? Will be based off the Dan Rawitch crystal ball.
Well, so what's the spread right now between the 10-year is sitting at about what, three and a half, and fixed rates are what, 6.5?
They've dipped from that. I think I actually saw yesterday, heard some high fives, but low sixes. I'll pull. By the way, I'm pulling up Rate Watch right now, and let's see what Optimal Blue Index is 5.979 today, conforming.
Okay, so right about 6.
Jumbo is 6.175 according to Optimal Blue's aggregated rate barometer.
So historically, we'll see between 150 and 300 basis point spread between mortgage rates and Fed funds rates. Sorry, not Fed funds rate, the 10-year. And so if you apply that same math at a 300 basis point spread, which is on the high side, which we are on the right now, we're on the high side, then and we hit 1%, we're looking at 4% rates.
So 4%. So is that your number? Because I'm going to check you. Like, we're going to write this down, and 4% is the Dan Rawitch.
Yeah, so I'm saying between 4 and 6, absolutely.
Looking like a true. Are you running for an office that we don't know about? I didn't know you were a politician.
Maybe, but no more than 7, Dave.
All right, well, guys, I wrote it down. It's 4. So, the NBA had predicted 4.5 by next year, which I think was conservative, and most people would agree with that. But so Dan thinks we're going to see it this year. And when do you think we can see something that starts with a 4? If you had to predict, when we hit 4.9, what would you predict?
Probably third quarter, because I think by fourth quarter we could really hit 4. So third to fourth quarter.
Well, so let's just say August. August, September, we're going to see 3.9 or 4.9.
Yeah, definitely by September of 24 for sure.
Okay, cool. So let's go around the room. Todd, any questions or takeaways, or if anybody put anything in chat, anything you want to make sure Dan talks to?
Well, I mean, here's my takeaway, right? My takeaway is this: if you're a loan officer who's watching this, and you have clients who are in the high 6s, low 7s, and you're not calling all of your database now to set them up as the true mortgage professional that you are, that you're got their back, that you're doing whether it's an annual mortgage review or a mid-year review or whatever you want to call it, you should be checking in with everyone that you know in your database and letting them know that, hey, rates are going to be lower in the third and fourth quarter, and I'm watching this for you, and then establish what their target is, how much do they want to save, or what's their magic rate, so that they know now you're looking after them. Because what's going to happen is, we all know it, right? The marketing is going to start up mid-year, and they're going to be trying to steal your clients, and you have the opportunity to be ahead of that marketing now while you have time. So I'm just going to encourage you all to own your database now and start committing to a certain number of database calls every day, every week, in order to make sure that you get the refinances that you want. Don't let someone else get your loans.
So I'm going to share something and then let everybody, Deborah and everybody speak to it. But guys, it has never been more clear that you got to have your database monitored. There's just going to be a windfall of opportunity if you have Sales Boomerang, because, we are going from rate triggers, we have cash out triggers, but literally Rate Watch, like, hey, when rates hit this rate, it automatically creates a total cost analysis for you. So, to Todd's point, and I actually interviewed Tim Brahim this week. It was released on our channel yesterday, and Tim was sharing his scripting, how when he's closing a loan, he's positioning the next loan. So I think it's never been more important that you're stacking the deck. And then I think it's never been more important, guys, that when you're every borrower that you're closing, you're showing like, hey, here's some options. What do you think is going to happen when rates go in the forwards? Do you think that it's going to be harder to get your offer accepted? So you're showing a TCA that says, hey, we get sellers to do concessions right now, and you're showing that. And then in column 3 or 4, you're showing, hey, what if rates hit 4.5? This is what it looks like. So you're using that to help get homes into escrow, and you're using that to, position for the next loan. So Deborah, anything you want to say or ask Dan before we have Todd Bellinger share his takeaways?
Well, I want to put an exclamation point of how you started the call with knowing the data and then educating with the data. And this is a perfect opportunity. You guys could all take a picture of your screen right now, or say that you're watching Dan, who's the chief economist with MortgageCoach, and how there's more to it with what you do than just being an order taker loan officer. Obviously, anyone tuning in, we are a true mortgage strategist. And so you tune into calls like this, or you're a part of Dan's group to really understand the art and science behind how interest rates work based off the numbers. So, I'm always pushing that your advice that you're posting on social or the videos that you're creating has got to be better than Chat GPT or a Google search. So how else are you doing that with true data, or leveraging people like Dan and the content that he's just provided, where everyone on this call could take exactly what Dan just did and make your own market update video for Monday that you then go one-to-many by leveraging social or a mass email to everybody in your sphere and on your audience and social channels.
Hey, Dan, people ask if you would share your slides. Are you going to share your slides, bro?
Me?
Yeah, will you share your slides so people can check them out and
Oh, you mean
them?
give them to you? Absolutely. Yeah.
So Dan will give me the slides. There'll be a link to them. If you're watching this on YouTube, there'll be a link down below, and I'll put them in the file section of our channel. And I just want to make sure folks, you're learning. Like, this is a teaching tool for me. You're learning what I call, being a data-driven mortgage advisor. You've got to be a mortgage coach. That's due north, so that you're delivering advice at the point of sale. What Dan just covered, this was just a lesson on knowing the data and educating with data. And when I talk about turning your database into a data bank, that's making sure that you have a CRM. It integrates with Sales Boomerang and MortgageCoach, and that you're literally be able to create predictable revenue. And then, of course, know your numbers. How many people are you talking to? What is your conversion rate? Are you winning by noon? I want to make sure we're connecting the dots on all that. Todd Bellinger, any takeaways you want to make sure people get, or any questions you have for Dan? And you're on mute. And by the way, guys, just so everybody knows, Todd is an actual real deal professor. I mean, not only is he a mortgage entrepreneur, but he is a professor at the University of North Carolina. And do they teach how to control your mute at North Carolina, University of North Carolina?
Ouch, ouch.
Shots
Apparently not.
made.
Oh, come on. Todd's a friend of our
By the
channel.
way, Todd's a 20-year, very good friend of mine. And Dan and Todd, not Todd Bookspan, but Todd Bellinger is absolutely one of the smartest people in the mortgage business. That was a dig too. I didn't even mean for it.
That's a dig at the mortgage business.
This is like a roast.
Yeah. The bar is
That
low,
would be a
but
great call. We should do a roast one Friday.
Yeah. So if anybody wants us to roast each other, let us know. But
I'm in.
what you got, bro?
Yeah, sign me up for that, man. No, I was gonna I got lots of questions for Dan. I won't ask them all now. I'll bug him later, but I definitely just going to share a few slides based on our conversation about, this bottoming process that we're going through with housing, and how much like COVID was an event-driven impacted world. This is an interest rate driven impacted world. So it's a lot of artificial stuff is sort of, creeping in. And I think I don't know. If you want me to, I'll bring some slides up and we'll do a little quick
Not
short
yet.
story.
Do you have any, if there was one takeaway people got from Dan, or if there's one question you have for Dan, and then let's have you go through your slides.
Just how important the interest rate cycle is here to housing and the recovery and what's happening. It's critical to watch, be aware of, stay on top of it, get out in front of it. It's just, it's going to drive a lot of major behavioral shifts financially across the whole spectrum.
Cool. So Dan, Rawitch, can you stay for another 15-ish? Because I want you to, one, hear what Todd's going to share, and then two, I want to have a little closing thoughts. Can you make that work, Mr. Rawitch?
You bet. Absolutely.
Okay, guys, so I'm going to tee up, when I invited Todd Ballinger here, I from stage have been, opening up with, guys, this is not just another year in the mortgage business. Like this is a new era in mortgage. And my case for that is, for my 37 years in the business, rates have done nothing but gone down. And now they went down to 2. And we had 2 back-to-back $4 trillion years. So literally 80% of every mortgage in America starts with a 4 or lower. 63% of every mortgage in America starts with a 2 or a 3. And so it's going to require a new level of skill as a mortgage professional. And by the way, as a realtor, listing agents have never faced something like this, where the majority of people who have mortgages on their home have lower rates, vastly lower rates than where they're at. And probably in many cases, people that start with a 2 have lower rates than they might ever be again. And if they do get down to the 2s again, it's really brutal out there. So you need to be a data-driven mortgage advisor. And I asked Todd to come and bring some data so that he's going to educate us on how this is not just another mortgage market. It's not just another year in the mortgage business and real estate business. So Todd, you got 10-ish minutes to deliver that with data, and then we'll all talk about it.
Great. Now I'm sitting there thinking, oh, that should have done a totally different presentation. That's good for my confidence. I think this will work. I started this out. I was like a title. Real estate recovery is always a tale of 2 bottoms. And we're talking about a bottoming process. And over on the left here is a chart of the biggest predictions for the coming year. And one of them was bonds are back, and the other is interest rates. You can't see it down there very well. It says interest rates will drop, right? So those are the 2 that I'm really focused on. And when it comes to real estate recovery, especially, and the insane year that we've been through, a lot of people keep asking me, like, when are we going to see this thing turn around? When's this thing going to bottom out? And at the end of the day, it bottoms first with activity, and then second with price, traditionally. Because there's a cycle that leads us down, there's a cycle that leads us up. And much as Dan said, everything can be charted. I like to say everything cycles. You have lots of cycles, and when you're at a bottom, it tends to be the time when you feel the worst, right? So it's it could be, I made a big mistake getting into this mortgage business. What the hell was I thinking? If I'm new, or I made a big mistake staying in it. But ironically, it's the point of maximum financial opportunity, right? Because this is the difficulty with trading anything is you want to buy more when it's up here and it's exciting, and you want to get out when it's down here and things are really, really cheap. And one of the charts that I thought was interesting, again, to this point of looking historically, and we'll bounce around a couple of different charts, is that so much of what's happening is simply rate driven. The demand is still there. People want to buy houses. Their lives haven't changed. I read a lot of these younger bloggers in finance, buyer bloggers and stuff. And it's interesting how many of them have shifted to talking about, screw it, we're buying a house. We can't wait anymore. Our kids are getting bigger. We don't have time. So this demand starts to build up, and there's a lot of kind of coiled spring happening right now in the housing market. But it's been, crazy. If I went right to Dave's point about how crazy it is, you thought 2008 was bad when it comes to home sales. I mean, we're down below the great financial crisis, which at that time was, for most people, would have said is the end of the mortgage industry, the end of the finance industry, the end of housing, and we're down in those kinds of territories. which is strange because it hasn't felt as violent and as bad this time around as it did if you lived through that particular period. We've got all these other offsetting factors that are happening, which is part of something Dave and I talked about. We do this chart every year, looking at, again, the largest asset on most people's balance sheets, over 84% of Americans, the largest asset is their house, right? If you're fortunate to have a discretionary cash flow to build wealth outside of a 401k and IRA, you feel this because this tends to move up and down a lot more. But you feel this in a different way. You're not going to change your behavior. I don't live 10% less large in my house because my house value went down 10%, but it does have an impact on your net worth. And even in the last year, house prices were still up almost 10% on a year-over-year basis compared to the S&P. So you've always got these offsetting dynamics, but we've got tremendous volatility. We have the largest spread between expected year-end targets. So when you're asking Dan to predict, it's a tough thing, man, because everyone is seeing tremendous volatility out there, and that's caused by so much of this uncertainty. But you have to put the uncertainty in perspective. And again, eventually, this is probably the most important thing I've been sharing some in our recent coaching groups, is price is completely irrelevant to anything but other prices. So when you have people that were used to 2 or 3% rates for a long period of time, and it goes to 4 and 5, and we've now had, I think it's 12 months under 7%. So psychologically, what's happening is people started seeing 7% even briefly, and that becomes a new benchmark. And we get down to 6 and we get down to 5, and these numbers start to drop. Psychologically, it feels like a good deal again because they've reset around these new numbers. And so they won't be thinking about the 2 anymore. They're going to be thinking about the 7. That's so important because so much of this stuff is psychology and behavior. And the other thing that many of you have seen this, but even if we see prices, decline another 15% based on current equity, we have a very tiny percent, 3.5 to 4% of consumers in the United States will have negative real equity. So, again, we could go down to the 15, we get down to 20%. But when you talk about prices going down 20%, we were up 24% almost last year. You're back to 2020 real levels. So this fear has to work itself through the system as we bottom out, and we're coming in at a time where real household real estate wealth is at all-time highs. There's never been this much real estate wealth in a house, and we're also topping back up here, where the average homeowner has about $257,000 in equity right now in their house, right? So they can handle some jiggering around of the values. And this means as this demand starts to get unleashed, this equity can be utilized to buy new properties. And this is where, again, the bottom will come sooner than later. The big variable is inflation and interest rates in terms of how fast it comes. But even if things just stay like they are, the demand will continue. People are going to have to trade down. I love this one. Senior home equity just crested past $12 trillion. These are seniors, right? These are people that have bigger houses that want to get out of and buy smaller houses. This is reverse mortgage and HECM type opportunities. This is some senior demand. They don't want to buy old houses. They want to buy new houses, smaller one-level houses, right, that they can move into. Tremendous opportunity there. And again, they're moving into this retirement age. So there's tremendous equity that's built up. There's tremendous demand being built up. And much like the COVID shock of employment, this is an incredibly resilient economy so far. On a relative basis, the great financial crisis, we saw this kind of an employment recession, and look how long it took to get back. This is the COVID shock and the recovery from the 2020 employment recession. And you can see the job growth is just off the charts. And Dan mentioned this as well. We just saw a redonkulous print of over 500,000 new jobs. Now, whether that's sustainable or not, I don't know. But you've got all these people sitting out there, as Dave mentioned earlier, with these, 3 to 7% kind of things. And for many of them, you could unleash about 50% of the demand potential out there if we could get into the 4s. Because these are about 33% said I'd transact to buy a new home right now if I could see something below 499. about 21% under 599, about 8% under 6. So as this thing trickles down to 699 and 599, you're just unleashing more and more pent-up demand and potential at a simultaneous time when people are leaving the market. And again, we are at these incredibly kind of low levels of activity, but there's some green shoots that are starting to happen. We're still well below home ownership rates and where they traditionally tended to be. We're still undersupplied. This is one of the challenges, is inventory and the undersupply that's out there. But I'll wrap with a couple of green shoot slides here. The tide is shifting. We're starting to see mortgage purchase applications, again, both double bottoming and moving up. We're starting to see inventory get worked off. We're starting to see the median house price turn up again and start to increase as new listings are coming online. And we're starting to see the number of people that are actually starting to increase their listing prices start to tick up again. And you can't do that at the bottom of a recession. I mean, you can, but overall, you're seeing even wages. And this is kind of cool to me. I mean, the average food service person's making $18 an hour. That's wage inflation, but it also creates an opportunity. It brings people into the housing market that weren't candidates to buy previously, if they can get the down payment and the saving stuff to work out. So again, overall, we've been through a tough time, but we're, in my opinion, starting to find an interesting bottom here. And the real question of this particular bottom and where are we now? I don't know. If we're somewhere, I don't know where you think we are, Dan. I know in the financial stock market, we're probably not as far along as we are in some of the housing market stuff that's happening, but we're probably getting down here. At least the conversations I have, people are somewhere between panic, leaving the market, leaving the industry, capitulation, despondency. And again, it's a horrible time to live through, but it's also the point where things are about to really turn around and a lot of opportunity can come out of that. So I'll stop there. It was a chart storm, but there is a lot of great equity. There's a lot of great wage growth. There's a lot of great, again, employment dynamics, tremendous resiliency in the economy so far. We haven't sold off to the depths of hell in the market. That could still happen for other reasons.
So Todd, that was incredible. I mean, this has been a incredible presentation by both of you. If you can stop sharing your screen so we can fireside chat this. Yep. People have been asking for your slides. Can you share those with me? And I'll
send you after we're done.
Guys, you'll have Dan's slides making a case for lower rates this year. You'll have Todd's slides really making a case for we've never seen a year like this. And it's actually pretty exciting. Dan, first of all, what are your thoughts and where do you think we are in that stress curve?
It's funny you're asking that because the first question that I had for Todd, but he didn't answer it, was where he thought. And I agree from a housing standpoint. I really think we're down there. I think that's my whole slide. I think the shift's coming, and it's almost as if he and I rehearsed to be on the same page, because we could have really been arguing right now. But I 100% agree with what he said. Stock market, I feel, is different. Believe it or not, I think we're still way up there in denial.
I think we're at the euphoria, still blow off top stage with the market.
It's like,
it's crazy how far apart they are.
You guys both agree that there's still a bottom to be had.
I believe the third wave down is going to be a doozy.
A doozy.
Okay. Yep. So community, if you've got questions for these guys, we've got 10 minutes. Get it going. I will tell you guys, you are lucky that you are in this mortgage coach community, but you've got to turn that into action. You've got to upgrade your skills. You need to be able to, obviously these guys are masters. They live this. They've got slide decks with, 30 plus slides, but you need 10. You need 10 slides. You need to make sure you're giving families a total cost analysis. You need to make sure you're tracking your database and it's being monitored. And guys, I really believe this could be a spectacular decade for data-driven mortgage advisors that build the skills and take action on what everyone's hearing. Dan, do you agree with that? It's an exciting time for people that are doing the right things.
Yeah, I almost feel sad because I know people are still leaving at a very rapid rate. They just can't hang on. But those of you that are here are going to really benefit from that. I do think it's going to be a very interesting good year. It's not going to be a 2021, of course, but it's going to start ramping that way. I think, somewhere late second quarter.
All right. Deborah, any questions you have for either of these gentlemen or takeaways you want to?
Well, I was curious with the job loss, do either of y'all think, and I'm just thinking from inventory standpoint, do we think people would be selling and maybe that would help increase inventory because of losing a job or being without pay? I mean, do we see that at all just for a light at the end of the tunnel with helping some of these buyers actually find homes?
I keep saying this, I said it in the COVID recession, that how housing just transcends these recessions. That's just the macro demographics, the buyers are so strong. I mean, what Todd said, it's just so true, because think about inventory declining. We have affordability is at an all-time low. I mean, it's worse than it was during the Great Recession. But I'm not seeing that from a housing price standpoint or from an inventory standpoint or from a desperation standpoint. It just seems to keep on kicking. So I don't think, and also, and this actually, somebody said this on my Facebook page a long time ago. I wish I could remember to give them credit, but they said, what about all the people sitting on their 2% loans? Aren't they going to hold on no matter what? And the answer is yeah. Who's going to sell their home with prices down and they're going to have to go get a 7% rate? Nobody, unless they're really, really forced. And I think that's going to be a small portion of the population.
I think we can, a good savvy loan officer and realtor can make a case to rent out that. If you're in a place where you want to move up and your income supports it, your lifestyle wants it, they'll be able to move up. That will just be a rental, they'll keep an asset, so, but you got to be the kind of loan officer, the kind of realtor that can navigate that help a family see the light.
Yeah, having strategies for people so that if they think it's binary buy, sell, then, you're doing a disservice, because there are multiple ways to accomplish financial planning goals, from sell leasebacks and things like that to, we used to do stuff with the kids would buy it from their parents and give them equity for, doing stuff that they wanted to do. There's just lots of different strategies. Reverses, I think, again, going to become a huge part of the financial planning world. Eventually, we're going to get through the sort of the stigma there, but it's going to become a need. Again, 2% is a great rate, but if you suddenly are sick and you need to, sell your house, you're going to sell your house. If you get divorced, you're going to sell your house. So these life events are going to also continue to churn inventory. Builders are strangely, after all of those cancellations, we had that record cancellations last month. Now they're saying that a lot of those clients came back and are actually going through and refilling out the contracts. And so they're getting more optimistic. And that's one of the problems that we have, Deborah, again, is inventory. We need builders building new stuff because we're behind the curve without the attrition rate of just new home formations that's happening and all the bursts and other stuff. And we're way behind the curve from a demographic standpoint on housing in the U.S. So some stuff's got to change.
Here's what I want to do. I'm going to hand it off to Todd in a minute to provide Win by Noon coaching and next steps. Both of you guys have incredible services that I want people to know about. Dan, in like 30-ish seconds, and then Todd, I'll hand it to you. If someone wanted to follow you, learn from you, sign up for your services, how do they do that? And then I'll come to you, Ballinger, and then Mr. Booksdale will close it out.
Well, I think the first way, which doesn't cost any money, is our Facebook group, which is Trade Like a Wall Street Pro. And it seems people seem to really be loving the group. I'm doing live presentations once a week, posting some pretty good content there, and doing one live stock pick a week for that group, and our win rate remains over 90% over the last 68 weeks. So our picks are pretty good. Or if you want to come watch us trade, I put that, I think that link's in here somewhere.
Cool. So follow there, and then you still have Market Mentor too, I assume?
I do. Absolutely. Okay. Marketmentorship.com. What's that?
Oh, I just want to make sure everyone knows that, Dan provides a daily update in our community as a mortgage coach. So your guys are getting that, but follow that. And then Todd Bellinger, what's, in 30 seconds or less for anyone who wants to get your training and know more about what you do, how do they do it?
Yeah, so I'll give you, I'll put the Facebook thing. I just put the link in the site, but if you go to facebook.com/knifecla, that's where I post 2 or 3 charts every day with commentary. So just things I'm following and reading. So if you're interested in that kind of stuff, go follow me there. It's free and you'll get all kinds of little updates and insights. And then come to varsmartuniversity.com. That's where you can learn about our certification program. We've got a blog there that you could follow. Finishing up today, my rebuttal to Rick Edelman's famous 10-11 reasons to carry a big long mortgage, and sharing the things that I agree with and the things that are just completely wrong about that. So go there, check out the blog and read, and hopefully that'll help you as well. But appreciate the time, Dave.
All right, if you could both send your slides to me ASAP, and I'll make sure that when we load this up into YouTube, there's links, Google Doc links to both of those, and I will also put the hard files are in our Facebook group. So Mr. Todd Bookspan, King of Win by Noon, how do you want to wrap it up, bro?
I want to wrap it up echoing what you just said, Dave. You all sat through 55 minutes of amazing education from 2 of the smartest people that I know. And now it's your time to take action, right? If you just watch this and you learned, then that's entertainment, right? We're going to take action on what you learned. And so you need to think about the fact that these folks are going to provide their slides for you. Think about what is the social post. I'm going to steal a little bit of Deborah's thunder, but I'll let her close it out with it. But what's the educational conversation that you can have with your borrowers and realtors today? Like, what resonated with you the most, right? You had, 30 different slides you saw. There's got to be one image, one idea that is the one that you should be picking up the phone as soon as we hang up and start making phone calls. And like I said before, if you're not thinking about your next refi wave today before rates drop, guess what? Your competition is. And so I just can tell you that the number one thing that you can do is start tidying up your database, start communicating more to your database, both email, text, and on the phone. And then, of course, Deborah will tell us about the social piece. But the bottom line is that's what this community is all about. It's providing you with the best information so that you can go out there and actually change lives. So Deborah, how are we going to do this socially?
Well, so I always say, learn something new every day. And the more we learn, then the more we can serve. So these are 2 phenomenal groups that everybody could immediately join and to use, make sure you give them credit, but use their charts and their data. We know the amount of hours that they're spending analyzing these charts. Take it and now use social for good and spread financial truth through your platform so that we can help educate and control the narrative based off truth and not just fear, which we know is a lot of what the media does. But you have to be a practitioner and study your game. I think social is a little bit of accountability for most people. And if you're not studying, then sometimes you don't know what to say and you don't know what to talk about. So these are 2 groups that you could be a part of. Make sure you click the notification button so that you see when they drop new things in there. Or if you're not a part of Todd's blog, it's phenomenal. I get it. And I love reading his commentary. But this is the only way I can create the amount of social media that I do, is because I take courses like the CLA course and I study it, and I know I can get better, but I know every post or every story or every video shared, that even if it's just one person that it can help make an impact for, then it's worth it.
Love it. Love it. All right. Well, everyone, as always, we're super grateful for both Dan and Todd for joining us today. We're grateful for all of you for watching here. If you're watching this in YouTube, give it a like. If you're watching this in the Facebook page, come on, give it a comment so that it gets some traction within the group. Dan, Todd, as always, I've learned so much from you and made so much money because of Dan Rawitch. So if you're not doing his things, then you're silly. You are silly. And so thanks as always. We appreciate you guys pouring into our community. We'll definitely have them both back so we get updates as we go throughout the year. But on behalf of Dave and the whole crew at Mortgage Coach, Deborah and her Plug and Play SM crowd, and myself and the Win by Noon community, thank you much. We really appreciate all of you.
All right. Love you all. Thank you.
Yeah. Take care.
See ya. Nice
See ya.
meeting you, Todd.
Good to meet you, Dan.
Bye.
We'll talk.